welcome everybody to this Coface webinar, and let's get started with Julien to share with you our views on and the latest thoughts of the new normal of our economies in the world. Julien, the floor is yours.
Is that of course this reopening will occur no later than by the end of the summer in Europe, in the US, and it's already underway. And as I said, and as you can see on this chart, the vaccination process is much slower in the rest of the world. We have a few exceptions, Israel, Chile, the United Arab Emirates, but beyond them, frankly, the process is quite slow, even in large emerging markets. So what does that mean? It means that in the next 6 to 12 months, I mean, this part of the world will still be stuck in this stop and go process that we have recorded in Europe and in the US in the last months. So how now the next question is, of course, how do we translate this sanitary picture into our economic scenario? I mean, here you can look and you can see our usual forecast charts and figures. And of course, I mean, world GDP growth forecast points to a significant increase this year compared to last year, which is no surprise because last year was, as you know, a record decline globally. Same thing regarding global trade, where we expect exports in volume to increase by +6 to +7% this year compared to last year. And even last year, we have to admit, we have been surprised on the upside. As you can see on the small chart, which is in the bottom of the slide, I mean, last year, global trade declined by 5%, which is a lot, but it could have been worse if you compare to what happened in 08, 09. And if you compare the decline of global trade last year with a decline in global GDP, to make it simple, the ratio 1 to 1. While in 08, 09, we had a ratio of 3 to 1. So we didn't have last year the overreaction regarding the adjustment of global trade we had in 08, 09 because of various reasons. Of course, the first one is that this time this was a services crisis. And you know that mostly global trade deals with goods. And the second point is related to something that we all know very well, that this time we didn't have any problem of financing. And that's the reason why we didn't have neither any overreaction in terms of global trade adjustment. And last but not least, in 08, 09, we were exiting a long phase of strong growth in terms of global trade, +6 to +7% because of the commodity boom, because of China's inclusion in global markets. While last time, I mean, you know, we have been talking about protectionism in the last year, so the starting point this time was very low. And that's also the reason why the adjustment was less significant. So all in all, a pretty good outlook in terms of global trade. As I said, then the picture is, of course, very different from one country to another, from one region to another, with the outlook being different between, on the one side, emerging markets, I will go back to it, and on the other side, mature economies. But even within mature economies, as you can see on the left, we record significant differences. Within Europe, we clearly see that economies which are more driven than other ones by services activities, like the UK and to a lesser extent Italy, you could have said Spain too, which is not on the chart, are still lagging behind. We're still lagging behind at the end of the first quarter of the year. So their GDP was still, let's say, about 10 points lower than it used to be before the crisis. In other economies like Germany, which are more driven by manufacturing activities, the shock was not the same. But despite this, we were still 5 points below the pre-crisis levels. And on the top, of course, you see the US, where we're almost back to pre-crisis level because of course, a very significant stimulus coming from both administrations. I mean, the one from Donald Trump and the one now from Joe Biden. And you clearly see the impact here on the chart, which is on the left. The yellow bar show you the different steps in terms of fiscal stimulus, and you see with a very simple way the impact on the consumption of goods and services, with of course this still huge gap between the two, services and goods, which is a good summary of the situation. Of course, because of lockdowns, mobility restrictions, services have been much more impacted and the pace of recovery is not the same. But in the US, regarding goods, consumer goods, automotive, electronics, we see also some good trends in other B2B sectors like paper, chemical, and so on. The latest figures show a very positive and rosy picture for the months ahead. The point is, because of lockdown, I mean, people saved a lot, and you see it on the right. The savings rate has never been so high in the past, but amounts related to this fiscal stimulus are so huge that even if a large part has been saved at this stage, it's sufficient to boost private consumption. And the paradox is that since the starting of the year, we even see more and more signs of shortages in terms of raw materials, in terms of inputs in the electronic sectors. You know it, and that's the reason why in the US delivery times, as you can see on the left, has never been so high, and those supply chain issues are surprisingly growing because of various factors. So regarding, for instance, the problems related to the supply of electronic inputs like chips, at the beginning of the year, large producers coming from Taiwan, from Korea, were saying this is going to be a short-term issue. It's not going to last long, and it's going to be solved within the next 3 to 6 months. And now they're changing their mind, and they're saying, okay, it's not going to be solved anytime soon, perhaps by the end of the year at best, but the most likely scenario is that it's going to be solved sometimes in 2022, because as you know very well, there is a lag between the timing of the decision to increase production capacity by investing and the timing it has an impact on production. So this is something to have in mind, because it can restrain a lot of businesses. For instance, for the automotive sector globally, estimates show that global sales this year will be cut by 1 to 2% because of these production constraints. So I'm not saying that the global market will decline by 1 to 2%, because the global market is recovering fast, but it could have recovered faster without this, of course, production constraints. So next step, a lot of people are linking these supply side constraints to inflation, because in the same time we see rising inflation figures in the US to a lesser extent in Europe, but frankly, inflation at 2% in Europe, this is not a big deal at all. We start from a very low point, and having a little bit more of inflation, it's to me a sign that we're not in stagflation and in stagnation, sorry, and it's also a sign that it will perhaps make it a bit easier to solve the debt issues for corporates and for the states. In the US, inflation stands higher, above 4%, and we will see tomorrow the next figure to be released. But the paradox is, if you look at the detail of the drivers of inflation in the US currently, you see it on the right, the key drivers are not related to supply side issues in the manufacturing sectors, at least some of them. The key drivers are related to, of course, higher commodity prices. I will go back to it. And the second type of driver, you see it in more in the top and in the middle of the chart, which is on the right, are related to the increase in prices of some services. And this part is perhaps more puzzling, but this is also the reason why this is something where we can be optimistic. The reason why inflation is currently rising in the US is because 1 year ago, a lot of businesses during lockdowns, especially in services activities, cut their prices, meaning that now 1 year after, in April or May, when we compare the level of prices with the one year ago, of course, we see that prices are higher, but this is purely a base effect. And that's the reason why we're not specifically worried about inflation in the US. Of course, figures are higher than they used to be, but it's more an adjustment and a catch-up following what happened last year. Exactly what's happening with GDP. This is exactly the same way we have to look at these yearly figures. Having said this, we see almost all commodity prices booming, and this is also something which is surprising. The extent of the increase is surprising. We see oil prices increasing. They are now close to $70 per barrel of Brent. Of course, we think there are some overreaction regarding oil as usual in the recovery process. But nevertheless, we're already in June, meaning that now the yearly average should be close to $60 to $65 per barrel for the full year. And of course, this is going to be a big source of support for a lot of emerging market economies in the quarters to come. Here, you see the outcome of our in-house statistical model to forecast commodity prices in the next 6 months. We do that for 13 commodities. You see here a summary for some soft commodities, for some metals and oil and natural gas. And the key message is that for the bulk of them, prices are likely to remain elevated in the next 6 months, and even to increase a bit further according to this calculation. And it's in line with perhaps what you can read in newspapers regarding soft commodities, weather conditions, for instance, in Latin America and in Asia, means that prices are likely to stay elevated in the next 6 to 12 months. On the metal side, we see, of course, a structural higher demand coming from the need for investment in electric batteries, in greener energies, and this is structurally driving the price of some metals like copper, nickel, cobalt, for instance. You know them. But the point is, even if we look at steel, we have been talking for years and years about overcapacities coming from China. And if we look at the situation now in terms of overcapacities in the steel sector in China, it's not the same as the one it used to be 4 to 5 years ago. As you can see here, depending on steel product, but broadly speaking, the situation is not the same anymore, and there are less overcapacities than they used to be. That's the reason why we have less reason to think that steel prices are going to correct and to adjust down very significantly in the months and in the quarters ahead. And by the way, you know that every year we make our own corporate payment survey in China. If you're interested in it, you can we can send it to you. We've just released it a couple of weeks ago. So we survey hundreds of companies, as you can see here, from all sectors. And the key points to remind and to have in mind this year is that, of course, some sectors, the situation in terms of payment in some sectors has improved. I was quoting metals, this is one of them, but it remains tricky in a few number of them, especially energy and construction. You see them in the bottom of the chart. And by the way, this is in line with the number of corporate bond defaults you see on financial markets in China, which is increasing fast, and mostly because of those two sectors, construction, real estate, and energy. So be cautious if you are related to those two areas. In the rest of the world, and more specifically in emerging markets, so as I said, I mean, on the one side, the good news is emerging markets will be driven by exporters from emerging markets will be driven by the recovery in the US. For example, Mexico will benefit from it. Will to a lesser extent benefit from the recovery in Europe too. Nevertheless, the faster than expected recovery in the US also poses some risk to emerging markets. And the first one, you see it on the left, which is related to capital outflows. We have seen some in the last months, because higher rates in the US means that more investors invest to the US and less invest to emerging markets. And if you combine this with higher inflation in a lot of emerging markets, because of higher commodity prices, because the weight of those commodities, for instance, food, is higher in emerging markets than it is in Europe and in the US. The outcome is that inflation now is already above 6% in Mexico, in Russia, above 8%. The latest data came out yesterday in Brazil. So it means that central banks have to hike rates. And this is what you see on the chart on the right, while they didn't want to do it, because growth is still quite slow in those areas. And so they're stuck in this tricky situation. So for large emerging markets, as I said at the beginning of the presentation, on the domestic demand side, if you combine the management of the sanitary crisis with those stop and go to continue in the next 6 to 12 months, plus higher inflation and higher rates, I think it means it's in line with a cautious stance for large emerging markets driven by domestic demand, like Brazil, like India, for instance, just to name a few. On the other side, of course, emerging markets which are more driven by exports of commodities, as you can guess, the outlook is better for them. Assuming that, of course, their financing needs in terms of for the government is not too high, because this is something also we already highlighted during the countries conference a few months ago, and of course this is still valid. Activity in a number of them will be constrained, because unlike the US, unlike Europe, they don't have the tools, the means to boost further domestic demand by using the fiscal tool. Here you see on this chart all key emerging markets, and for the bulk of them, you see that the bar is in positive territory, meaning that the financing needs in 2021 has increased a lot for the government compared to 2019. And among them, you will see the usual suspects, South Africa, Brazil, Algeria, Tunisia, where we have to be cautious in terms of public debt. And so what does that mean? It means that those governments will have to face tough choices. First, they have to find some ways to finance this extra debt so they can tap the domestic market. But the problem is that domestic banks, if they give more resources to the local government, they will have less to finance private companies. Or they can tap the external market, but in that case, they face a currency crisis, of course. Or, of course, the other alternative is to cut spending, but in that case, the risk, you know it, is to foster a kind of social discontent, and we're seeing it at the moment. I mean, again, some months ago in January, we were showing you this chart regarding our own assessment of social fragility in emerging markets, combined with the exposure to the COVID-19 crisis. And we were saying, of course, a lot of Latin American countries are at risk given those two metrics. And we've seen in the past what's happening in Colombia, what's happening in Peru, and in some other countries. And this is a good highlight and a good summary of risks related to this dilemma for governments, cutting spending or having to deal with social discontent. And this is something which is going to last, of course, in the next 12 months. So that's for the overall, let's say, macro country risk picture. Then now you know that the elephant in the room is not really the macro picture, but since the starting of the crisis, the elephant in the room is definitely the disconnect between, on the one side, this macro picture, and on the other side, the micro run on payment, on liquidity, and on business insolvencies. Here you see a summary of, let's say, key government support measures that have been put in place by key economies in the world. They have been prolonged in key economies, and that's the reason why we have not seen at this stage a large number of business insolvencies happening in key markets, especially in major economies. And frankly, since the starting of the year, the picture has not changed much. Especially in Europe, you see the number of business insolvencies has not increased much. In France, it has not increased much, neither in the UK. It's even lower than it used to be. Last year. The picture is a bit different perhaps in Germany, where it looks like we are back to normal if we look at the monthly number of business insolvencies. And last but not least, it has changed in Spain, where we record a higher number of business insolvencies since the starting of the year. So that's for the past. Now, what can we expect for the coming months and quarters? This is definitely a tricky question. I mean, we have to be humble on this. I mean, remember what happened last year. All international organizations, all credit insurers, we had the same type of forecasting model by taking into account our macroeconomic GDP forecast to forecast business insolvencies. And by the way, of course, it didn't work, as you know, last year. So at Coface, we try to change and to adapt to this new reality, this new normal. That's why we have developed a new kind of model. And again, we can send to you the full paper if you want to better understand the complete methodology which is behind this. Where in Europe, we look at the financial situation of businesses on a sector-by-sector basis, and for each of those sectors in key markets in the Eurozone, so France, Germany, Italy, and Spain, we apply some shocks in terms of turnover, shocks in terms of staff cost, to take into account the positive impact coming from furlough schemes, and last but not least, the impact coming from guaranteed loans, where we assume that as long as a company doesn't have to start repaying its debt, a guaranteed loan has a positive impact on liquid asset of the company. And the reason why we do that is that thanks to that, we can recalculate a gross operating profit to net debt ratio for each sector in each and single country. And in the past, as you can see in the bottom, this gross operating profit to net debt ratio had a very good correlation with the number of business insolvencies of the given sector. And so we use that to forecast the number of business insolvencies, which is a good way to take into account the impact of government support measures. And by doing that, you see the outcome on the right. It points to an increase in business insolvencies in the quarters ahead. The increase would be much more significant in Spain than in other European countries because of the sector composition of the countries and the increased weight of at-risk activities, especially on services side, and it confirms what I showed you a couple of minutes ago. It looks like we start to see it in figures. Having said this, as I said, we have to remain humble. It's a good way to have a better view of the outlook by taking into account the impact of government support figures. Nevertheless, it doesn't tell us anything about the timing of occurrence of this adjustment. So we don't know if it's going to happen in the next weeks or in the next months or in the next quarters, but nevertheless, those missing insolvencies are likely to occur according to this calculation. So that's the key messages of the presentation. I leave it here with the usual countries map. The next one will be released within a month, so in early July. So you will see the adjustment which takes into account what I've just said. And of course, I mean, feel free to, as always, comment, questions, and make all remarks you want. Thank you.